Canada lost 18,000 jobs in April. On the same day, the United States added 115,000. That gap does not happen by accident. It maps directly onto a structural fault line that tariff uncertainty has been widening since January. Canada has now shed 112,000 jobs in the first 4 months of 2026. That is the steepest 4-month drop since January 2021, the deepest point of pandemic-era labor collapse. The unemployment rate has climbed to 6.9%, a 6-month high. In the United States, the unemployment rate held at 4.3%, historically low, with the prime age employment to population ratio at its highest in 25 years. The causal chain here is not complicated. Canada sends more than 1/3 of its GDP across the border as exports. When tariff uncertainty poisons that trade relationship, the ripple runs fast and deep through manufacturing, logistics, and services that depend on cross-border flows. Stellantis, General Motors, both cutting back on Canadian production. And this week came the most telling signal yet. Honda canceled its planned $15 billion electric vehicle plant in Alliston, Ontario, a project that was supposed to be one of the largest industrial investments in Canadian history. The Bank of Canada now faces a narrowing set of options. Before Friday's data, markets had begun pricing in the possibility of a rate hike to defend the Canadian dollar and match U.S. tightening posture. The jobs report extinguished that expectation. TD Securities and others now argue the case for holding rates is stronger. The loonie fell immediately after the release, as traders repriced the rate differential between the two countries. The divergence between Canadian and American labor markets is not just a statistical curiosity. It is a real-time signal that tariff exposure is asymmetric. What happens next in that divergence depends heavily on a story unfolding several thousand kilometers away. That story is oil, and oil this week refused to behave. West Texas Intermediate crude swung from $107.46 to $88.66 within a single trading week before settling near $97 a barrel, a 7% weekly loss, even with Brent above $100. The cause is not supply or demand in any traditional sense. It is the Strait of Hormuz and the war that has turned it into a geopolitical variable traders cannot price with confidence. U.S. forces struck 2 Iranian-flagged oil tankers in the Gulf of Oman on Friday, firing precision munitions into their smokestacks to disable them. A third vessel had already been disabled earlier in the week. Iran, meanwhile, seized a sanctioned tanker carrying its own crude, a move that illustrates just how tangled the shadow fleet logistics have become under blockade conditions. The U.S. is applying maximum naval pressure, while simultaneously signaling that a diplomatic settlement may be close. Trump's stated priority is reopening the strait at all costs, deferring the nuclear and missile file until later. Markets do not know which signal to trust, and that uncertainty is doing more damage than either a clear war or a clear peace would. For Canada, the oil volatility cuts in 2 directions at once. Cenovus Energy just posted one of its strongest quarters on record and used the earnings call to warn that oil sands growth is drying up. CEO John McKenzie said the national policy conversation has become myopically focused on the climate agenda and that the investment numbers are already reflecting that. Canada has spent over a decade making itself one of the least attractive jurisdictions for new oil sands capital. When prices spike on Iran headlines, the Canadian sector cannot easily ramp production to capture the upside because the investment to build that capacity was never made. Enbridge's posture stands in direct contrast. The pipeline giant sees the best North American energy investment climate in over a decade, with a $40 billion secured backlog and confidence that energy demand will drive infrastructure growth regardless of geopolitical noise. Enbridge benefits from volume throughput, not price direction, making it structurally different from producers like Cenovus, who need stable policy as much as stable prices. The tension between those two readings, Cenovus warning of structural underinvestment, Enbridge bullish on infrastructure demand, points toward a fork the market will have to resolve. These two chains, the Canadian labor market fracture and the Iran-driven oil volatility, are not parallel stories. They intersect at the same underlying question: how long does policy-driven uncertainty persist, and who absorbs the cost while it does? Canada's labor weakness does not resolve on its own. The 112,000 jobs lost since January are concentrated in sectors exposed to U.S. trade flows. Honda's retreat from Alliston is not a one-time event. It is a data point in a pattern that includes Stellantis capacity reductions, GM pullbacks, and now the emergence of Chinese EV makers as the only credible industrial suitors willing to consider Ontario manufacturing. BYD, Chery, and Geely are already scouting dealership locations in Canada after bilateral tariffs on Chinese EVs were cut from 100% to 6.1%. Whether that pivot becomes a real manufacturing anchor depends on battery content rules under CETA and whether Ottawa can structure a deal that creates genuine local value rather than kit assembly. On the oil side, the leaning tilts toward continued volatility rather than resolution. Trump's strategy of reopening Hormuz first and resolving nuclear issues later is not a peace deal. It is a phased negotiation with no clear timeline, and Iran's behavior suggests it will test every phase. WTI settling near $97 with Brent above $100 reflects a market that has priced in partial disruption but not full blockade. If diplomatic signals firm up and Hormuz reopens meaningfully, crude could retrace toward $88 quickly. That would relieve pressure on Canadian energy costs and airline operating margins, but it would also remove the price floor that is currently supporting oil sands producers despite their structural warnings. If talks stall and naval incidents escalate, $107 is not a ceiling. The verification benchmark to watch: WTI holding above or below $97 in the next session will indicate whether the Friday naval strike shifted market sentiment toward escalation or containment. On the labor side, Statistics Canada's May employment report, due in 5 weeks, will either confirm a trend reversal or extend what is already the worst 4-month jobs run since the pandemic. The one scenario that challenges both leanings simultaneously: a rapid Hormuz settlement that collapses oil prices, strengthens the Canadian dollar, reduces import inflation pressure, and gives the Bank of Canada enough room to cut rates. That sequence would change the macro picture considerably, but it requires Trump's phased approach to move faster than any current signal suggests it will. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.